All right, is the Federal Reserve lost in the fog of economic uncertainty? Welcome back to the program. I'm Jeremy Szafron. Today, after holding interest rates steady at 4.25% to 4.5%, Fed Chair Jerome Powell admitted he doesn't know what the central bank will be fixing next, inflation or unemployment. Let's take a listen.
A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile, there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out. And also, when they do settle out, what will be the implications for the economy, for growth, and for employment? I think it's too early to know that. So, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy. Our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
All right, we just don't know. That is today's message from the world's most powerful central banker. Markets are still pricing in 3 rate cuts this year. And for the first time publicly, Powell is now admitting last year's rate cuts may have come a little too late. Meanwhile, President Trump's new tariffs, the steepest in over a century, are already fueling recession fears and inflation risks at the same time. Here to break it down with us is Danielle DiMartino Booth, founder of QI Research, former Fed insider, and one of the sharpest voices on Wall Street and Main Street alike. Danielle, thank you for being here.
Thank you so much for having me on this Fed Day.
Yeah, on the Fed Day, speaking of which, I saw you on Fox. You've been working all day, and I know that we don't have you for that much time. So let's get really started with this one. Powell says that the Fed is well positioned to wait, but the Fed's own Teal book reportedly shows core PCE now headed to 3.5% by year end, unemployment up to 4.7%, GDP slashed to under 1. Isn't this the classic stagflation in motion?
Well, it certainly could be, but just bear in mind, like any forecast, the only thing that you should read through to the Fed anticipating rising inflation is that which a model has produced. Mm-hmm. So when you look at actually what's happening here on the ground, when you see that apartment rents keep falling, of course, shelter's the largest input. When you see that home prices have begun to decelerate rapidly in terms of the appreciation versus what we were seeing just a year ago. When you see what's happening with the price of oil, all of these suggest, again, that the Fed is basing their prediction, basing their forecast on a model as opposed to a different construct, a market-based construct. And in fact, the Fed has followed what they call market-based core PCE in the past, and that metric now is running below the Fed's 2% target. So it really depends, again, on whether you're following a model, an economist's predictions, which is what you're talking about, mm-hmm. or whether you're following what's actually happening here on the ground.
Yeah, and it seems like the cracks are starting to form at a very quickly pace. Before we get into some of that macro data that you're talking about, you forecasted up to 5 rate cuts this year based on the weakening labor market, but the Fed has already held steady. Has anything changed in your outlook? Do you see multiple cuts ahead despite this Fed's hesitation here?
I do see multiple cuts ahead. I think that that the Fed nodding to the fact that both inflation and unemployment have further risk to the upside. And that's about the only thing that they changed in this statement. This statement was almost an exact copy of what we saw in the prior FOMC meeting. But because they have flagged upside risks to unemployment and inflation, and because Chair Powell also said that the Fed was prepared to either delay or act more quickly, depending on how the data play out going forward, that we could indeed see the Fed moving as soon as June. And in fact, that is what a lot of economists right now foresee in the future, that we are going to see much more upside in the unemployment rate before we start to see any kind of an impact of the tariffs on inflation.
Okay, interesting. So if the Fed doesn't move till quarter 3, what kind of consumer damage are we risking by then?
I think if you're actually talking about the Fed not moving in July, not moving in June sooner, that you really could start to see some major blowback from the Fed being too high for too long. In fact, if you just read the Beige Book and you run the Beige Book through natural language, I think it's natural processing language. I'm showing my age here. But if you run it through a program and just looking at the words of the Beige Book right now, the economy is actually in worse shape than it was prior to last September's meeting, when the Fed had to push through with a 50 basis point rate cut because it had failed to do so at the prior July meeting. I see a similar setup now, given what we're continuing to see with companies reporting layoffs that are not abating, as well as a fast quickening bankruptcy cycle.
Yeah, let's get into some of that research. I mean, you've said repeatedly Main Street feels pain long before Wall Street blinks. I mean, we continue to deal with that on this show. Labor force participation still below pre-COVID levels, and sentiment is collapsing in surveys. What are you seeing on the ground in QI data that the Fed is missing?
Well, I think the Fed is leaning much too hard on hard data that is very lagged in nature, that also does not reflect the sheer number, millions and millions of Americans who are working side jobs, gig jobs, Uber drivers, DoorDash drivers, because what they can make working part-time is so much more than what they could make collecting unemployment benefits. So I think it is to the Fed's detriment that the Fed is being willfully blind right now if they don't acknowledge what several Fed policymakers have. And in fact, we've got 6 Fed speakers slated for this Friday, but several Fed members have begun to say, we need to pay closer attention to the survey data, because we've never had this wide of a disconnect between the hard data and what Americans on the ground are telling us. What the fact that internships have really collapsed, the availability of them going into this summer. The fact that the class of 2025 graduating from college is saying that it's even worse than what it was in 2024. There's plenty of anecdata, including, again, the Fed's own Beige Book, that suggests that the Fed is to its detriment ignoring what's being seen in the soft survey data.
Yeah, you know, you've been vocal about the Fed losing credibility. Many have. It's been turning a little bit political. Powell admitted today that the fall of 2024, when those cuts, they weren't preemptive. He said, if anything, they came in a little bit too late. How damaging is that admission in your view?
Well, it's going to be more damaging in hindsight.
Yeah.
And it's certainly going to be more damaging if we see, as many economists, including Bloomberg's Anna Wong, if we see this violent pendulum swing back, layoffs that we're seeing in freight and transportation, leading cyclical sectors of the economy, if we're to see actual layoffs in May and in June. And in fact, she and I both anticipate the very high risk of seeing non-farm payrolls print negative as soon as this upcoming May payrolls report, which of course precedes the Fed's next meeting on June the 18th.
You were talking a little bit on today. Charles Payne, I was watching you on the show. I know you've been on air all day, and you were talking about these 7 bankruptcies as of late. Can you get into that a little bit, and how bad is it getting here?
Well, just to give you some context, what I mentioned today with Charles is the fact that in the entire month of April, we saw 7 large bankruptcies. That would be bankruptcies of companies with 50 million or more in liabilities, just 7 days into the month. If you include Standard & Poor's downgrading last night to strategic default, an office REIT with $2.14 billion in debt. Just in the first 7 days of May, we've seen 7 large bankruptcies. And by the way, a handful of them have been multi-billion dollars in liabilities. One of them was in the freight sector, but between $100 and $500 million in liabilities with 5,000 to 10,000 creditors. to back up these major, large bankruptcies that we're seeing come through at a much more rapid pace in May. We're also seeing the pace of small business closings pick up appreciably, as well as household bankruptcies being up 16% year over year in the month of April. I'm sorry, but these are not subtle signposts. These are definitive signs that the Fed should be lowering rates right now, that Chair Powell and other Fed officials who are leaning too hawkishly should be cognizant of and acknowledging by easing policy.
Yeah, the Fed reiterated, I guess, today that the Treasury runoff will continue at just $5 billion per month, meaning any maturities above that cap will be reinvested. Market watchers are asking here, if the Fed is mechanically rolling off its balance sheet, why did it just buy roughly 35% of both 3-year and 10-year Treasury auctions last week? I mean, is the Fed quietly stepping in to stabilize the market here?
No, it's not. In fact, I just muted somebody on my Twitter feed because they insisted that the Fed was relaunching quantitative easing. That is simply not the case. The Fed has publicly stated, as it did in its March meeting and reiterated today, that it reduced the pace of the roll-off of its balance sheet to $5 billion a month. And what that means, and the Fed has publicly stated it, is that if there is more maturity of treasuries than that $5 billion cap, then it is obligated to maintain the size of the balance sheet by reinvesting proceeds of those treasury maturities. And that's exactly what it is doing. There is no tacit quantitative easing going on. The only way that you could see that would be if the Fed's balance sheet was to stop shrinking. But on a net basis, it is still shrinking by $5 billion in treasuries a month. And by the way, I would add that we've seen an increase in mortgage prepayments. So we're seeing more mortgage-backed securities rolling off of the Fed's balance sheet than we were a month, 2 months, a year ago, up to $35 billion a month. That quantitative tightening has not been reduced at all.
Interesting. Thank you for clearing that up. I was seeing some of that rambling there, too. We got to talk about China. Obviously, we're talking about tariffs. That's been a lot on the conversation. Not quite sure as to what's going to happen there. But China just unleashed a broad monetary easing package. I mean, they're cutting policy rates, they're slashing the reserve requirement ratio, and pumping over $130 billion into liquidity just hours before top officials meet with the U.S. Treasury. Does this signal that Beijing is bracing for a deep, protracted trade war? I mean, how could this wave of Chinese stimulus spill over into U.S. markets and complicate the Fed's already fragile outlook?
Well, look, the United States is the world's largest economy. China is the world's second largest economy. And just a few days ago, when it released its services PMI, a gauge of the service sector health, it disappointed to the downside. And even though China has a larger industrial base compared to that of the United States, the fact that both its manufacturing and services sectors are stalling means that the government is rightly trying to stimulate the economy and defend it against what it knows is going to happen because of the trade war. Global trade is going to contract for the full year of 2025. This will slow down China's economy, and its policymakers are right to be right now easing conditions in the economy. Just because they do, though, does not necessarily mean that Chinese companies are going to be willing to borrow more just because it's cheaper to do so if they don't foresee going forward that they're going to have business to back that up. Everything is contingent upon exactly how these trade negotiations are going to play out.
Yeah, well said. And here back home, we've seen that sharp uptick in commercial bankruptcy filings you're talking about, particularly among those mid-sized firms. With rates still elevated and credit spreads, creeping wider, are we staring down a balance sheet recession? But more importantly, I guess, where do you see the first real break? I mean, is it regional banks again or the corporate debt market?
So we certainly are seeing the first cracks, if you will, in the regional mid-sized banking sector, and that has a lot to do with the fact that there's a higher volume of commercial real estate transactions that are occurring right now, and the higher the volume of commercial real estate transactions, the more price discovery that there's going to be at these banks, and the more losses that they're going to have to recognize. So I think that you're right in saying that that's one of the first places that we're going to be seeing distress, and because the leading bank in the United States, JP Morgan, has already increased its provisions for losses, increased its credit card charge-offs to the extent that it has. The largest bank in the country is also signaling to smaller banks it's time to continue tightening those credit standards at a time when many U.S. households, millions of U.S. households, are being faced with being penalized for the first time in 5 years for not repaying their student loans. So there's a lot going on right now that is going to impair credit to commercial real estate, impair credit to corporate America and to U.S. households.
Yeah. Final thoughts here. I mean, if Powell waits until September to act and the tariffs are extended beyond the current 90-day pause, what kind of policy misstep are we setting up for?
Well, I think we're setting up for a very large one. And I would be shocked to not see the unemployment rate surpass. Right now, it's 4.2%. The Fed has a year-end target of 4.4%. So I would be shocked if we were to get to the September meeting without the unemployment rate being well above where the Fed's current dot plot foresees the unemployment rate ending the year again at 4.4%.
Yeah, so that's the blind spot. I mean, the last question, I guess, if you were to advise Powell privately tonight, what would you tell him the Fed's biggest blind spot is right now? That?
I would say that the Fed's biggest blind spot right now is not paying heed to its own internal research. The Philadelphia Fed has said for 2 surveys running that Americans at a record pace are paying the minimum on their credit cards. And the Fed's beige book right now is flashing recessionary readings that were associated with the Great Recession. It's their internal data, and they should be paying attention to it instead of simply and solely waiting for the hard data reported by the Bureau of Labor Statistics to catch up to what we're seeing in these survey data.
Yeah. Sure as heck seems more clear now than ever. All right, Danielle DiMartino Booth, always sharp, always real data first. Thank you for being here with us on this critical post-FOMC day.
And thank you for having me.
Thanks, Danielle. You can follow Danielle's latest macro research at QI Research. For more in-depth interviews and market coverage, stay with us right here on Kitco News. I'm Jeremy Szafron. We'll see you next time.